But first I would like also to say welcome to our overseas listeners on the web. We have a lot of new international shareholders from Washington, from Singapore, from London, and we have also individual shareholders in Europe who are at the moment probably in the web in order to listen to our presentation. Yeah, and the presentation has some highlights, and a big highlight is that we have been very successful in the last year, and we are building the roots, we're building the platforms for a global future. So I wanted to tell you about 2016 being a fantastic year, another strong year which we had. But further on, we actually built the roots, the platforms for the future. And why I'm talking about platforms, if I look actually at this little tree, which is a Ficus sycamorus, which is a fig mulberry. And that's a tree which you find in Africa going up to Cyprus. So even in Cyprus you find this tree. It has very strong roots, has strong branches, and grows nicely. And that's exactly what we will get with these two acquisitions you see here on the side, Remedica and Cytec Nutrition. They will give us the strong roots, the platform for further international growth. So we want to talk today about, I will give you an overview. Kieron will focus on the financial review. Then I talk about the operational successes of the three divisions and our international business, how that has been doing, our strategic focus, and then an outlook going forward. So Ascendis has come a long way. And of course we know, meanwhile, what is Ascendis? It's a health and care company with a good diversified mix between pharma-med, consumer brands, and phytovet. And this is the mix end of the reporting period, end of June 2016. On the right, you see actually our tremendous growth on sales and profits. And just the 3 years CAGR has been quite tremendously with 87% on the sales growth and more than 100% on the normalized earnings side. So that is a fantastic achievement based on strong brands, based on a strong management. Here's Cliff. Cliff runs our South African business, the MD for South Africa, and Kieron, who you met actually at half-year results presentation in March, our CFO, and then myself running this business, based, of course, on strong divisional leaders, and some of them are here today who have actually managed to keep the business successfully growing. And the successful growth you see also in our market cap on Friday, sorry, this is the Monday number from Monday afternoon, 12.2 billion. Sorry, it's from yesterday afternoon even, we updated it. 12.2 billion, nice share price development over the reporting period. And share price, of course, is something, but also the market cap is important to look at. And we started actually the year 1 year ago with around 3 billion market cap and ending with a 12 billion market cap. So close to 4 times increase over the reporting period. But also in comparison to other companies, we are featuring quite well. This was an analysis I showed you at half-year results in March. And there are not a lot of companies who have grown their normalized headlines earnings per share over the last 3 years consecutively over 25%. And Ascendis is one of the few. So also that's quite nice. But this is, let's say, a little bit to the background. You are interested in the numbers. Let's look at the numbers. So high level, normalized headlines earnings per share grew 30% to 121 cents per share. In the booklet, in the details, the 121 is exactly 121.05. There is somewhere in the booklet a number which says 120.02. This is the wrong number, it's 121.05. Normalized EBITDA grew 41% to 613 million, and all based also on the successful integration of our Pharma Leader business from Spain. Remedica and Cytec were acquired after the reporting period, so it's important to see that the transaction costs, all the hard work for these two acquisitions, happened in the last 6 months, but the numbers will only flow in be accretive from August 2016. And then, of course, post-Remedica and Cytec, if you take, let's say, an outlook of the next year, Ascendis Health is now, from a market cap point of view, the second largest healthcare company in Africa. Now, if I say healthcare, I exclude the health service providers like hospitals, so classical healthcare companies. How have we been doing during the year? Now, just a quick overview. Organically, we grew around 8%, impacted by the drought, but based on growing export initiatives and also some of our divisions doing very well. Focus on strong new product development. I will show later some numbers and some pictures. We furthermore invested in our growth. Investments which raised equity of around 550 million during the year. This is not what we did after the year. And then after the year end, to a big equity raise of 1.2 billion in a rights issue, which was 3 times oversubscribed, and 1.5 billion in a vendor placement, which saw a lot of new investors coming on board. Some of them I see here, like Melville Douglas, like Old Mutual, or the IFC, which is on the webcast from Washington, who invested actually $30 million in our vendor placement with these 2 new acquisitions. Talking about acquisitions, also a successful year. We bought a relatively small business, but exciting because 80% of it goes into exports. A small business called AfriKelp. I talk later about this. It was accretive from February onwards. We bought last year in August a B2B pharma business in Spain called Pharma Leader. We also will talk about it a little bit later. And in April this year came on board Acacia. What we liked especially with Acacia is their plant. It's the ex-Roche plant, and we have a lot of opportunity to bring in-house and in-country some production, which is currently done in India, with, of course, foreign exchange fluctuations. This is something what you want to achieve. And then the 2 big acquisitions, 260 million euros paid for Remedica in total. We haven't paid everything because 90 million is actually deferred, 90 million euros over 3 years. And then 170 million acquisition of Cytec, of which 150 million had to be paid end of August and 20 million is deferred. But let me hand over to Kiron to give you details on the financial side.
I've survived the year-end audit. It was a great process, and I didn't do it by myself. It was a great team effort. So first of all, I'd like to thank particularly all those finance managers in all the different subsidiaries for all their long work and dedication over the last 2 months. 2 individuals in my reporting team, Nal Marie and Monique, really stepped up to the plate. Thank you very much. Your hard work and dedication, the weekends, the long nights have not gone unnoticed, and a lot of the success of these results is down to you too, so thank you very much. And then I'd also like to thank Cliff, Carsten, and the rest of the Ascendis team, as well as the Coast to Coast team. I mean, we faced quite a challenging economic situation, and as well as the worst drought the country's had in 30 years. Plus, we did 2 Category 1 transactions at the same time. So, yeah, thank you very much for everybody for all their hard work. Getting into the numbers, just to elaborate on what Carsten said, our revenue up 39% to 3.9 billion. A lot of that growth, about 30% of that growth, coming through from the acquisitions we made in 2015 and then in 2016. I've had to show a normalized EBITDA number, as Carsten mentioned. We've got about 150 million rands worth of transactions costs related to the Remedica and Cytec deal. We had to raise those as an accrual in terms of IAS 1, but I believe they don't really show what's happening in the underlying business, so we've added them back for this normalized EBITDA number. So with that number compared to last year, we show a growth of 41%. That represents 20 basis points up on our normalized EBITDA margin in 2015. Normalized operating profit was up 41% to 529 million. And HEPS, normalized HEPS, up 30% to 121.1 cents. That's with a 5% dilution in our shares due to the issue of shares. So our weighted average number of shares was increased by about 5%. Our overall HEPS went down 30% to 55.6 cents with the transaction costs in. So you can imagine we had fun and games trying to put together a trading update which said that our EPS and HEPS were going down by 30-odd% and our net earnings per share, our net headline earnings per share, normalized earnings per share was going up over 30%. And then when we come to our dividend, we've declared a dividend, a final dividend of 12 cents. This dividend is in line with our desire to keep on paying a dividend to our shareholders that grows year on year, but at the same time supporting our desire to grow the business through acquisition. If I can delve down into the income statement, I won't go into to all the lines, but just if I can point out a couple of pertinent lines here. The gross margin decreased from 43.6% to 39.9%. Now that's as a result of two things. One is the inclusion of Farmer Leader in our figures. So we've included 11 months of Farmer Leader. We acquired them in August 2015. They've got a much lower GP margin than the rest of the Ascendis business. They do have a higher EBITDA margin, however. So we didn't see a dilution on the EBITDA line as a result of the inclusion of Farmer Leader. The other factor driving our GP percentage down was our increased tender business. We've increased tender business in both the generic pharmaceuticals and medical devices division, which diluted our gross profit margin. Looking further down, our EBITDA margin was nearly up 0.2%, and this is still part of our strategy to increase this as time goes on, and we've seen a steady trend, an increase in EBITDA margin over the last couple of years. The other thing I'd like to point out is our interest costs or net finance costs. As you can see, an 80% increase in those costs. Those are in line with our funding, so we've increased our gearing in order to fund some of the acquisitions that we made during the year. The other pertinent line there is our tax number. You see our tax number actually goes down 21%, and this is also a bit of an anomaly as a result of the transaction costs. So the transaction costs pushed up our effective tax rate because none of those costs are tax deductible because they're not in the production of income. But Farm Leader has got very lucrative government incentives, so they pay a very, very low tax rate. So this is kind of balanced off. So our effective tax rate is about 24.4%. This is substantially down from last year where it was 28.2%. And at the bottom line there, our normalized headline earnings has increased 37.4% to 336 million rand. If we look at our earnings and revenue growth over the last 3 years, and these CAGR numbers are obviously quite flattering, coming off a fairly small base in 2013. So revenue 87% and EBITDA 111%. If I look at the CAGR from 2014 to 2016 on normalized headline earnings only, that represents a CAGR of 30% growth, which is pretty robust and something that we're very proud of. Now looking at the slide that most of you would be concerned about, so the HEPS and normalized EPS slide, we start off with a headline earnings amount. Now this is an amount that's taken the minority interest in Farm Leader off. Just to remind you, we own 49% of Farmer Leader. That was our first slug in the investment in Farmer Leader in Spain. We do, however, have a double casting vote on the board, so we're able to consolidate 100% of their numbers into our numbers, and then we take out the non-controlling interest down below. And that's what we've done in this calculation here. We've then added back the transaction and restructuring costs associated with Farmer Leader, with Remedica and Cytec. The bulk of those costs were related to finder's fees, to legal fees, to audit fees. So a whole bunch of fees that weren't related to the underlying business that we've added back. We also had a couple of fair value remeasurements on our deferred vendor liabilities, and then what we also do is we add back amortization on our intangibles that arise as a result of our acquisitions. So when we do our purchase price accounting, we recognize goodwill and intangibles. The amortization of those intangibles we add back in line with our peers in the industry. So on a weighted average number of shares of 278 million, we get a HEPS figure of 55.6 cents and a normalized HEPS number of 121 cents, which is our 30% growth. If I can go into the balance sheet, as you can see, the effect of the acquisitions during the year. So we had Farmer Leader, we acquired a company called Acacia in our Farmer Med division, and then we acquired 2 bolt-ons in our Phytovet division called AfriCulp and Club M5. As you can see, our goodwill and intangible assets on our balance sheet has increased with just under R1 billion as a result of those acquisitions. Our acquisition strategy has always been to target businesses with high return on net assets. We much rather buy brands and IP than bricks and mortar. That does mean a large part of our purchase price goes to these goodwills and intangibles line, but that does not make us less valuable. In fact, we think it's the opposite. Because these are high RONA businesses, we think it makes us more valuable because the business can sustain growth and generate a lot of cash out of those acquisitions. Saying that, with the acquisition of Farmer Leader and Acacia, we did pick up a plant in our Sando, which is valued at about R100 million, so that goes into our PPE line. And we also picked up some plant in Spain, which contributed about 33 million rand to our PPE line. As you can see, the current assets went up quite a lot versus last year. I'd like to go into a bit more detail in the next couple of slides. It's worth mentioning, primarily as a result of those acquisitions. If I have a look at the equity and liability side of our balance sheet, as you can see, borrowings have increased across the board. So we had a domestic medium-term note program, and an RCF and a bond, and we availed of those facilities in order to pay for some of our acquisitions during the year. So in terms of our gearing, this next slide shows you what's happening from a gearing perspective. We're looking at about a bank debt to equity ratio of 2.3. That's increased slightly from 1.8 in the previous year to 2.3. So we've geared a lot of the acquisitions. Our debt covenant at that time was 2.75, so we're quite comfortably underneath that debt covenant. But just to let you know that post-balance sheet, we've refinanced all of those facilities with the new debt that we financed through HSBC and ABSA. And our new covenants are around about 3. So still quite a lot of headroom for us in that regard. If I can chat to you about our cash generation, this is a very important metric for us. Typically we acquire businesses that have good, strong profit histories, but more importantly, we look for businesses that can generate cash. Now, as you can see in this year, our profit before tax, and that's with those transaction fees in, we adjusted that for any depreciation and amortization, and then we've seen quite a big increase in our working capital changes, which I'll speak to in the next 2 slides. The other thing that's affected our cash generated is our net interest paid. So 131 million was paid out in net interest, and tax was actually a little bit lower than what was paid out last year. Last year there was a couple of catch-up payments that related to the previous year, but all our tax is up to date in 2016. So overall cash, a negative cash was generated in 2016 of 146 million. If I look at how we used that cash that was generated, so we paid out a dividend, an interim from last year and a final dividend from the year before of 57 million. We then obviously we paid just over R1 billion for our acquisitions, the Farmer Leader, the Acacia, Club M5 and AfriCulp. To do that, we issued shares. There was a general issue of shares during H2 for 557 million, and then we increased those, we availed of those facilities that we had, and we borrowed money of 452 million. So overall, our cash decreased by 128 million. Saying that, this time last year, we had expected to close the Farmer Leader deal in February 2015. Fortunately, that deal had only closed in July 2015. So we were sitting long cash because we had raised cash in order to pay for that deal. So we were sitting long cash at balance sheet time, which obviously we're not in that position at the moment. Saying that, after year end, post our rights issue and vendor payments, we've got quite a bit of cash available in our working cap facilities and in our treasure chest for further acquisitions. So just to get into those working capital movements, what I've done here on this slide is I've taken the effect of the acquisitions we've made. So in the in the orange one there, in PharmaMed, that's Acacia basically. In the blue one, it's all PharmaLeader. And the green one, it's AfriCulp and Club M5. Taking the effect of buying those companies and adding those inventories, those debtors, and their accounts payable to our balance sheet, and looked at what was driving our pure organic working capital movements. So in terms of inventory, we saw quite an increase. A commercial decision was made in the medical devices division to ship a lot of the inventory that we have instead of air freighting it to try and boost our GP margins. We also won a tender in the scientific group, which is part of that medical devices division, with the South African National Blood Service. That tender is rolling out, started rolling out from about March onwards. So what we've done is we've bought a lot of that equipment. That equipment gets reflected as inventory, and as we place those assets, they get transferred into PPE. We then make money by all the diagnostic tests that we run through that equipment. Some of the other things that are driving our inventory balances, sports nutrition during the second half of the year consolidated a lot of their production facilities and their warehouses, and we moved all of our stock into UTI. We believe that they can do a much better job at distributing and invoicing our stock than we can. So we built up stock in anticipation of that to make sure that we didn't have any sales interruptions during that period. As I mentioned earlier, we've seen a marked increase in our tender business, particularly in our generic pharmaceuticals. So we built up stock for those tenders. And then, as Carsten mentioned, we have been quite seriously affected by the drought over the last year. So we had built up stocks in anticipation of a normal planting season. That unfortunately did not materialize, so we're still sitting with a lot of that stock in our warehouses. But that's something that we'll be able to sell through in the next season. It doesn't expire, so we're not too overly concerned about that. Just a note, we are embarking on, or in the process of a couple of SKU rationalization projects, particularly in our animal health division. There's probably 6,000 odd SKUs in that particular division, which we're looking to reduce by 1,200 SKUs over the next 6 months. In terms of the accounts receivable or the debtors growth over last year, just under 300 million rand. Again, with the increase in our government tender business, in our medical devices division, and our generic pharmaceuticals division, we've seen extended terms given to the government, and those debtors balances increase. The other thing that happens is that we sold some dormant dossiers in June for about 30 million rand, and we're only paid in July. So that balance has come down immediately in July. And I'm pleased to report that with our financial shared services in place, we're seeing sound working capital practices being implemented, and our debtors days are currently 58 days, which we're very comfortable with. The accounts payable balance, 197, that grew. 150 million of that is due to the accrual of 150 million rands worth of transaction costs related to the Cytec and Remedica deal. If I can have a look at our key ratios. So what we've done here is we've taken our sales, our revenue value, and our EBITDA value, and we've annualized it as if we had owned those businesses for a full 12 months. That resulted in a revenue increase of 32% and EBITDA increase of 43%. And then we've applied those ratios to these numbers. So if I look at our interest cover, a slight drop versus last year at 4.4, but still very robust, and it reflects that we've increased the gearing in our business. So we've increased the gearing from 1.8 to 2.3 times to pay for some of those acquisitions. Saying that, we've seen big increases in working capital, but if we look at the days, I'm very comfortable with the increase in actual days. And if I take out the effects of PharmaLeader and some IFRS adjustments, the days versus last year, inventory has gone up slightly for the reasons I gave earlier, but we've seen debtors days maintain and creditors days actually decrease. Looking at our return on equity, we see return on equity is 14.3% for the year, which is substantially lower than our ROTNA of 35.1%. Now, ROTNA, which is our return on net tangible assets, which excludes those goodwill and intangibles, reflects the return of the underlying business. So that's essentially the engine in Ascendis. This dropped slightly versus June 2015, which was 37.2%, and that is driven by that inclusion of 100 million rands worth of plant at Acacia and 33 million in Farmer Leader. We knew at the time that we bought Acacia that factory was massively underutilized, and the new management team that's been put in place there is actively working on increasing throughput into that factory. So we expect to see our ROE increase as a result of that. The other issue that dropped our ROE versus last year was the purchase of Farmer Leader. Because we've only got a 49% stake, we weren't able to gear that business, so we used equity only to pay for that business. And when we gear an acquisition, we use less of our equity to generate returns, and with a slight decrease due to a finance cost, we actually see a higher ROE as a result. So because we couldn't gear Farmer Leader, we've seen a slight decrease in our ROE. The effect of buying companies with a PE of around 8 and using our shares, which are trading at a PE of 20, also helps us to increase our ROE. Investors often ask us what our sustainable ROE is. I think we typically target businesses with ROTNs of 40%, and based on our ROE, we typically pay around 17%. So it depends on the PEs that we are comfortable paying. We're not comfortable paying very high PEs for some of the companies that we've purchased. So the PEs that we pay normally equate to about 17% ROE. So on the one hand, we have new acquisitions coming into the business at 17%. We've got our underlying engine producing 40%. So we expect that overall ROE to increase over time. Unfortunately, we're early in the cycle as a highly acquisitive business. We see we're closer to that 17% mark, and we've had to professionalize. So we've spent a little bit of money at the center. We've invested in a group treasury function. We've invested in group procurement function, but we certainly believe from here there's room for improvement. I'd just like to share a slide with you, the impact of including Cytec and Remedica in our figures. I just want to say this is not a forecast. These are based on pro forma figures. All we've done is taken the management figures, multiplied them by 2, and converted them at an average euro exchange rate of 17.21. So please, this is not a forecast. But what we see, the effect of including Remedica and Cytec in our numbers, is our revenue increases from 3.9 billion to 6.8 billion, and our normalized EBITDA effectively doubles from 623 million rand to 1.2 billion rand. So Ascendis is looking like a little bit of a different company. We've taken a step up. And what have these acquisitions done for us? So effectively, they've changed the mix in our business. So now PharmaMed is 50% of our business, our consumer brands is 40%, and Phytovet is 10%. But it's also stepped us up. We're now a true global company. We're represented in 140 countries around the world now. It's provided us with as a perfect rand hedge. So we saw quite a lot of devaluation in the rand in December, and then obviously more recently as well, the inclusion of Remedica and Cytec will help protect us against those types of devaluations going forward. We've also benefiting from lower tax rates. The tax rate in Cyprus is about 12%. The government offers quite valuable incentives on top of that, so we expect our tax rates to decrease further once we fully integrate these businesses. And it also gives us diversification, thereby eliminating our risk across the board. Thank you very much for your time.
Yeah, job done. Thanks very much to the finance department. Yeah, Kieron's talking about this diversification, and the diversification is the strength for our operational performance. And you will see this when you look at this slide. Of course, we are not happy with the consumer brands' top-line growth. That should be a plus, close 8-9%. But in an environment where we had extraordinary effects, and I'll show this a little bit later, as explanations, not excuses what had happened, but in the end, our team worked very hard actually to improve profitability. And when you look at actually the division of consumer brands, the profitability, the EBITDA margin sits now on 22%. They increased profits by 26% over the reporting period. Pharma-Med grew around 80% their sales and around 59% their profits. So there's also an explanation. One is what Kieron said already earlier on. Our pharma business was a victim of its own success. It grew its top line by 20%, but the bottom line of the pharma business is slightly dilutive to the EBITDA margin of that division, and that's the reason why the EBITDA didn't grow so much like the sales. And the last division, the phytovet division, impacted by the drought, around 75 million were probably lost, but beside that, even if you include all these negative effects, they still grow their business 13% on the top line and around 18% on the bottom line, again showing great synergy effects in that business division run by Jan Puffer, who's doing a great job actually of integrating and extracting synergies. When we look actually in a different way to present this, how immensely the sales have grown in the Pharma-Med division, of course due to acquisitions also, and I'll show later a split between organic and acquisitive growth. But the most important thing, what you as investors want to see, is the EBITDA growth of these three divisions, and they're all at healthy EBITDA growth. In these reports, first time we have Pharma Leader with 11 months in, and you will find in the notes to the AFS that we also report an international division. In the future, of course, international is only at one company at the moment, and we show this here. It's that 14% in the blue part being international, but if you integrate this into our Pharma-Med division, which from a product point of view, Pharma Leader belongs to the Pharma-Med division, you have a 55% profit share of the Pharma-Med business in the business, and from a turnover point of view, a similar share for the Pharma-Med division. I talked about diversification of a strength of our business. Another strength of our business is the diversification from a customer base point of view. And if you look at this chart, you see how diverse our business is from a customer point of view. And we could have even split the wholesalers in various wholesalers, so there's not a risk really from a dependency from a customer point of view. I remember 4 or 5 years ago when we presented numbers, we had one retailer A with 9%. That retailer A has still been growing for us, but the share actually has reduced now to around 8% as far as I remember, 6%. The strength of our business doesn't come only from the customer diversification, it comes also from the product diversification and from the strength of the products. You know, we are a brands company, we believe in strong brands. Why is that? Not because the brands actually can grow nicely and have good market positions and you can internationalize them. Strong brands mean price setting opportunities. So you're not a price taker, you're a price setter. And if you're number 1 or 2 in a market segment, you can more dictate the prices. And why is that important? Of course, it's important to improve your margin, but it's also important to pass on imported inflation via the rand volatility or the rand weakness to your end customer. And as our end customers are more mid to high LSM, in Europe they would call it mid to high income groups, these customers are affected by the consumer sentiment, but not as much as lower LSM customers. Interesting, on this chart you see now the Acacia products included. Acacia being run is a business which is run in the pharma division. They have OTC products, the market leading brand Reuterina, and also Sinocon and Sinoend, market leading OTC products, number 1 and 3 in the market. So you see them here as a joint position number 2 in the OTC market. Let's look at the divisions in a little bit more detail. Consumer brands, I mentioned it, fantastic growth from a profit point of view. What are the reasons for that? We have first a new leadership. We employed a gentleman from GlaxoSmithKline consumer division, Justin Korte, and he has done a great job in the first months actually extracting synergies and putting this division onto new footings. In our sports nutrition business unit, you remember we said this in the 3 months, in the March presentation after half year. We closed 3 sports nutrition production sites and opened a new one at the Pharma Natura plant. This came with challenges on the sales side, But on the profit side, due to cost-saving initiatives and looking at the operations and the processes and merging these three plants, Greg Anderson, who runs that division, has done a great job of improving profitability. Direct selling businesses, nothing has changed to the March reporting. We have some challenges with our Nigerian business, not only for converting the local currency into dollars and get paid in dollars, but also the consumer sentiment due to the oil price situation in Nigeria has impacted that business a little bit. But again, integration and cost savings over that whole division help to mitigate these challenges on the sales side. Nimue, our dermacosmeceutical brand, more of it half sold in Europe to dermatologists and to beauty salons, has done quite well and achieved numbers ahead of budget and strongly ahead of last year. And then the last point, which is for noting, we just had a function 1 week ago or 10 days ago here in just a few roads around, where we moved our IFC, the compounding center for individualized tailor-made medicines, into a new building, and we upgraded this, and with GMP approval, of course, you have to invest something there. So that actually gives also opportunities for the future in this consumer brands division. Pharmamed division, an amazing growth of around 80% of revenue and over 50% of profits. We have to explain this. Why is that? Now, first, Kiron mentioned Pharma Leader. Pharma Leader was dilutive on the GP line, and on the EBITDA line, it's not dilutive to Ascendis. It has a 15% EBITDA margin, but it was a little bit dilutive to the Pharmamed division, which had 1 year before 18.7% EBITDA margin, and now actually the EBITDA margin came also a little bit down from Pharma Leader. But nevertheless, Pharma Leader has worked according to expectations, of course also helped a little bit by the translation effects, but the business is doing what we expected from it. The next effect is the pharma division, the pharma business. The pharma business won very good state tenders. They grew their business compared to last year on the top line by 20%. So 20% growth for Viral and his team with the South African pharma business, not looking at medical and not looking actually at Pharma Leader. And as this business has slightly lower GP margins than the average of the division of Pharmamed, that also had an effect on the bottom line of the EBITDA margin. The medical devices division, you know, we sell high-tech products from international principals from all over the world because South Africa doesn't have a medical device industry. They did quite well after having a fantastic 2015. They could put something on top from a sales growth and from a profit point of view. So overall, a very successful division performance in 2016. Phytovet, there are two effects which affecting this division. One, of course, is the drought. We expect or we calculate that the effects on the drought cost us around 75 million rand. Again, shouldn't be an excuse, but it's an explanation why we even didn't grow further. But even with the drought, to show a 13% revenue growth and a 18% profit growth is quite amazing. It has something to do with extracting synergies. It has something to do with the Afrikelp acquisition, which only came in 5 months from February onwards, and I show a little bit later. And it has something to do with extracting synergies between Maltons, our pet and vet brands, and our Effecto and Avima businesses. Overall, EBITDA margin has increased again in this division to now 13.7%. I want to focus the next slides on our growth strategies. And this slide you have seen for the last 4 years, but it has changed a little bit. Because of our big 2 acquisitions, Cytec and Remedica, after the year end, and Kiron has shown you what it will do, what it will transform Ascendis to, we of course had to relook a little bit our growth targets because the base is now much, much higher. And we have adapted our acquisitive growth from 20 to 25%, which we always said, now to the lower part of the range of 20 to 25 to 20. The organic growth, we had always at 10 to 15%. We adapted it to the lower part of the 10 to 15% band. Synergies stay. We want to achieve every year 5% on the bottom line via synergies. That shows you that integration and synergies is very important for us. So much that actually we have now a synergy department. We call it actually a mix between synergies and integration, syntegration. And there are ex-consultants from companies like McKinsey and Bain working there, helping to integrate acquisitions, which is quite important. Another change here on international growth, we always showed 30% should be our international quota, or sorry, on the international revenue in percentage of total sales. Of course, the two acquisitions, Remedica and Cytec, changed this completely. So we have set ourselves now 50%, which we will achieve in 2017, and in 2 years we want to be 60% international with our business. Let's look at these 4 sections now in the next slides. Let's start with the organic growth, and you always want to know how our organic growth looks. So organic growth, if you discard the acquisitions of last year, was around 8%, and we have adapted this, of course, for the sports nutrition part and the drought. But successful projects to extract synergies, like I said, actually helped to improve profitability in this business. We had strong growth in pharma and medical, like I mentioned earlier on. We had strong growth in our contract manufacturing plant, Pharma Natura, in Isando, and we had strong growth, like I mentioned, in the Phytovet division. So around 8% organic sales growth, which is in the current environment, I think, a very good number. But sales is something what you want to know, but more important, of course, is profit. So what actually happened from an organic profit increase point of view. So on this chart, you see an annualized EBITDA on the left. Then you see the drought effect, like I just mentioned, on the profit side. Then the organic growth from a profit side, and then the 3 acquisition areas in PharmaMed, the international acquisition of Pharma Leader, and Phytovet. So the blue part was the additional EBITDA contributed by the international acquisitions, the green part by Phytovet, and orange by the PharmaMed. And you see that actually organically we increased our profit around 14%, which means actually on an 8% organic sales growth, we had around 14% 14% profit growth on the organic side. So how do you do organic growth? Now, of course, it has something to do with product launches. Here are some examples of our product launches in last year, and there are much more actually, which I could show. I just want to pick on this one, for example, Nimue. Nimue launched some new products from October last year onwards, and in total these products contributed just from October, being in launch phase, around 6 million rand over the year. This was a very successful launch in the pharma division. You know, our pharma business is a generics business. In generics, you have to be fast. You have to be the first to market. This was a product where we were the first to market. And then you measure actually your success against the originator. How did the originator do? How did your product do? So you see on the blue line actually from last year, August on, our pack size sales. And then you're on the yellow one, going down is the originator. So this product did very well. We expect hopefully close to 10 million rands of sales in the 2017 reporting period with this originator, with this generic, first launched after the originator's protection expired. Synergies. Let's look at synergies. You all know our structure, but important is we have this group shared services area where finance, HR, regulatory, treasury, supply chain offer services for the other areas. So there you extract synergies. There you find the extra margins out of these businesses. And we showed actually at the half-year presentation a few projects. Most of them are finished. Some of them are still work in progress. But the take-home message of these projects is we had tasked ourselves around 27 million to extract synergies, and it was slightly more. We came up close to 28 million out of these just of these projects, like the supply chain, like merging the 3 production plants in sports nutrition, warehouse consolidation, and some organizational changes, mainly in the consumer brands division, which helped with the EBITDA margin. Let's look now at the acquisitive growth, our growth strategy. So here you see actually what has been contributed in the PharmaMed area. The international acquisition, which is the PharmaMed acquisition, is mainly South Africa. The Sandoz dossiers, which are not contributing really yet, because these are dossiers which we still have to re-register, but they are to our name, and it will hopefully, the most effect will come in 2017, but the Acacia acquisition being important here. Pharma Leader, the blue part, and then the Phytovet division, AfriKelp, which I will focus a little bit on the next slide. Why is that? It's not a big business. We didn't have to announce it in the sense in January, end of January, when we did the acquisition, but we like this acquisition because it's a perfect acquisition from our strategy point of view. It's a bolt-on, bolted onto the Phytovet division, and it offers a lot of synergies. So what is it? It's a seaweed processing company from the active ingredient Oiklonia maxima, which is actually a growth stimulant. Growth stimulants used for horticulture, for agriculture, to grow your plants faster. Not chemically, it's a biological stimulant. So it's really coming from nature, and the guys who know Cape Town, we see all the kelp swimming, that stuff grows every day around 3 centimeters. And that growth is coming from growth hormones, which actually you can put into agricultural products. What we like with the business, 80% is going into exports, into dollar and euro denominated areas. We paid for the business 175 million with a mix between cash, shares, and deferred payments, and it was accretive in our numbers from February. So only 5 months in, not a big effect yet, because only 5 months in, but it offers also, beside the export of 80%, it offers synergies. And you are the first one seeing actually this mock-up here, which is a product which we will launch actually in the next 3-4 weeks into the trade. So the trade hasn't seen that yet, and I'm pretty sure that Jane, who runs that division, is a little bit angry with me showing this. But what is nice actually, do you see here, this is perfect synergy. Wonder is very strong in the retail sector, and AfriKelp, who wasn't in the retail sector, is selling now a product on the Wonder brand and using actually the strong opportunities what the Phytovet division can offer them. Another important acquisition, which a lot of growth potential for the future, is Acacia. Acacia was incorporated in April, so only 3 months in our numbers. It's the leading South African manufacturer for some OTC products, Reuterina, a probiotic. Everyone who has kids has had probably the problem, you give antibiotics, kids get diarrhea, so you need actually a probiotic, and Reuterina is the market leader by far in this segment. And then they have cold and flu products, Cynoent and Cynocon. They are in the OTC market Schedule 0 products, so they are seen as drugs by the Medical Control Council, but they are Schedule 0, so you can buy them over the counter, and they are number 1 and 3 in the market. Acquired for 245 million, with a plant of 100 million, and the plant is the ex-Roche plant, and we have a lot of opportunities, like I said earlier on, to bring currently produced products from India into that plant, and that has been started, this process. The first 3 months, according to expectations, so sales and profit is in line what we expected. But these are the past acquisitions, and let's look at our pipeline. Due to our capital raise, which we did post-year end, we have around 600 million rand in the kitty now. So with these 600 million rand, we can target acquisitions of approximately 100 million rand of PAT without doing an extra equity raise. And of course, US investors are concerned. You don't want to have the high dilution of shares. We had, of course, the big capital raise now in in August, end of August, but we don't expect really an equity raise in the next, hopefully, 9 to 12 months, but we have to see. On the South African side, we will search for bolt-on acquisitions, mostly with export opportunities, like the AfriKelp one. And internationally, of course, we have Cytec and Remedica, which we closed after year end, will be accretive from August onwards, and we're looking for other bolt-on acquisitions or strategic businesses in Europe, especially Eastern Europe and emerging markets. But that's the acquisition pipeline, and let's look now at the last area of our strategy, our growth strategies, the international part. This chart has improved very nicely compared to what we showed at 1 year ago, because it shows now an international rate of 22%. 22% of our business in the reporting period of 2016 has been international. The blue bar, of course, helping, this is Pharma Leader, but even the other areas grew tremendously over the previous reporting period. And if we wouldn't have had the drought, the green part would have grown even more, because you remember Avima is more than 50% normally international, but now this year it was only 34% international. AfriCelp, I mentioned 80%, Swissguard with Nigeria 63%, and the scientific group, we are quite proud of that. We wanted to achieve 30% international rate, and they are already sitting at 36% at year end. Foreign revenues cover now 54% of our imported cost of goods. But you can immediately, after telling you the number, you can forget this number, because with Remedica and Cytec, we don't have to focus on this number anymore so much, like the next chart will show you. So this is a little bit a different graphic way what we showed you already in the March numbers, which is a waterfall chart starting with our total cost of goods. Total cost of goods, local cost of goods, and imported cost of goods. So you see in middle, in the turquoise, you see 68% of our cost of goods are imported. And due to rent volatility, this is the area you have to focus on. So how do we mitigate this? Now you have in orange our export sales of 376 million out of South Africa, bringing dollar and euro revenues. Then you have the profit from foreign operations, which is our share of the profit after tax from Pharma Leader, 44 million. And then you have tenders, which nowadays tenders, the government is more generous I shouldn't say generous, but they're not lagging behind anymore, let's call it like this, giving you price increases if there is rent volatility. So that is more or less also okay. And then you have a part which we have to hedge with 777 million rand. And hedging, it costs some money, short-term hedging especially. So what do? We increase prices. That was the area which wasn't covered. But in the future with Remedica and Cytec, you see most of our hedging, actually more than close to 60% of our hedging we will not need anymore, because of the perfect rand hedge of having two big European or dollar and euro denominated businesses. So this is quite nice to see. It makes Ascendis less volatile on rent volatility. And after Cytec and Remedica being integrated, more or less that's over. Of course, we still have to watch rents, because the rent development, because we import still 68%, but we can mitigate this. And this is quite important. This is important for you as an investor. We don't have that foreign exchange risk anymore. International expansion doesn't come only organically, only acquisitively, it comes also organically. So we actually grew strongly with Phytovet opening new offices in Africa. The AfriCelp business helped. We set up a business development manager based in Australia who looks at our consumer products, mainly sports nutrition, and introducing, hopefully very soon, Solal in Australia. We set up a new export office in Johannesburg, and the scientific group did quite well. Nimue found a new agent in Denmark. We lost that agent, unfortunately, and is setting up new agents overseas, mainly in Asia. And then we are looking already now at cross-selling opportunities between Pharma Leader, Remedica, Cytec, and also between Cytec and our Consumer Brands division, which hopefully will actually happen in 2017. The next slides, I want to focus a little bit on Remedica and Cytec. Of course, they are not in the numbers of 2016, but a lot of effort has gone in last year into these numbers, into creating these businesses, and therefore I just want to show you a very quick video, it's only 2 minutes, on the Remedica business.
The city of Limassol, built in the shape of an amphitheatre on Akrotiri Bay, Limassol is the second largest city in Cyprus and home to one of the biggest ports in the eastern Mediterranean. It is here, in the pharmaceutical metropolis of the island, in a bustling industrial and financial centre, that Mr. Chris Patikis founded Remedica in 1960. Remedica produces 300 different pharmaceutical products, representing more than 2,500 marketing authorization licenses worldwide. With a strong market presence in over 100 countries, including various EU member states, Remedica has won a plethora of awards and accolades for its business activities, its support to the health sector, its philanthropy, and its overall contribution to society. As a result of the establishment of collaborations and agencies with companies around the world, and through supplies to many non-profit organizations, millions of patients throughout the world benefit from being treated with pharmaceutical products produced by Remedica. In recent years, Remedica has increased its activity and investment in the development of new products. This policy has led to a gradual but sustained rise in the number of products manufactured, and the innovative concepts have been protected by international patents. In addition, the company makes this technology available to other companies around the world through licensing and supply agreements. And there has also been an added bonus in that the availability of these new products has enabled Remedica to penetrate new markets. On its site in Limassol, Remedica has 11 buildings with a total area of 40,000 square meters. Of these, 5 are manufacturing units, each of which is dedicated to the production of a specific class of product or products. So, along with the main factory, there are additional facilities which have been specially designed for the production of medicines containing penicillins, cephalosporins or hormones, as well as a new factory for anti-cancer products. Building number 10, which was the most recent manufacturing unit to be completed, was designed for the manufacture of anti-cancer products and is the pride of Remedica, representing a major investment for the company. This ultra-modern, standalone building houses its own production, packaging, storage, research and development facilities, and of course, auxiliary and service spaces.
A very exciting plant. Whoever has the chance, and we will in the future offer also investors to have maybe an investor day there to see the plant. But this plant is really exciting. It has GMP licenses, has several licenses with 8 organizations, because quite some business goes also to 8 organizations with their 300 products and 2,500 authorizations in different markets. What is important for us, it provides us a platform, routes to go internationally with our pharma business, and into internationally meaning into Europe, but also into emerging markets. The business is a generics business, but a highly specialized generics business, a lot of oncology products. And there you see a packaging Aramed of one of the first route to market oncology drugs they actually had developed, and that's important. In generics, you have to be either unique or you have to be fast to the market, or you have a branded generic. So our model is uniqueness and being fast to the market, and Remedica actually is doing that. We paid 260 million rand plus 90 million rand deferred over 3 years, 75 million euro, sorry I said rand, that would have been a cheap deal. 260 million euros and 90 million euros deferred. 75 million euro is actually based on an EBITDA performance with hurdles. If they achieve more than 25% growth year on year on a certain number, they can get an additional earnout. The business is accretive from August 2015. Historic numbers reported to you, audited numbers, 14.5 million euro PAT. That was December 2015 when their year end has been. And it's before actually add backs. The business performance in the 6 months to June was according to expectations. The EBITDA in these 6 months actually grew by 13%. So we're quite happy with that. And what is also important, EBITDA is something, but you want to see what's on the bottom line. And especially, like Kieron said, with 12.5% tax rate in Cyprus, there's even more path to follow. We started already first integration projects with shared services, with finance. Kieron has even employed already, together with Remedica, an employee who will be purely looking at reporting issues between Remedica and finance shared services here in Johannesburg. And we started first synergy projects also with Pharma Leader, set up already in August. The second acquisition, Cytec. Cytec is the #3 leading sports nutrition brand in Europe, with leading market positions in countries like Poland, in Germany, in France, Spain, Portugal, Hungary, many markets in Europe. And just to give you the size of the business, around 100 million euro turnover last year. So 1.6 billion rand turnover just with sports nutrition in Europe. Let me show you something on Cytec.
Nutrition, premium quality products, state-of-the-art look, uncompromised ingredient quality. Our products work and taste good. www.cytecnutrition.com.
If I would go on with the video, you would see a lot of, let's say, minimally dressed people. So that's the reason we stop here. It's a sports nutrition company focused on well-being, on strength training and functional fitness. And you can imagine that people in the gyms, they are a little bit less dressed than we are at the moment. So let's stop the video here. They export to 90 countries worldwide. They have around 280 products in their range. The production side you saw is GMP, Good Manufacturing Practices approved, and FDA approved from the US. So that's quite important. The acquisition completes Ascendis wellness offering and its strategy to find a base, a platform in Europe to grow the business in Europe in sports nutrition and also with some other wellness products. We paid 150 million, and we have to pay another 20 million euros in 1 year's time, 20 million deferred, accretive like Remedica from August onwards. Audited numbers for financial year 2015, which ended in December, 10.5 million euros. And the business performance for the first 6 months was according to expectations, around 6% EBITDA growth until June 2015. Also here, interesting tax regime. The maximum tax rate is 20%. We pay slightly less, and we have projects on the go with our auditors. How can we structure taxes between our different entities to bring that even further down? So that goes very well in what Kieron said earlier on, our outlook going forward. We expect on a corporate tax rate to have actually lower tax rates in average over the whole company going forward. We started also here first synergy projects in production, in R&D, and in cross-selling in several markets. And Greg Anderson, who handles our sports nutrition business, went together with me just 2 weeks ago, and we sat with the whole team. And we also introduced actually the Ascendis way of doing business, our values, our mission, our core values actually to the whole staff in Cytec a few weeks ago. Yeah, last 2 slides. Let's look at the what is in for us for the future. Now, I showed this slide very similarly actually a few months ago, and we stopped there actually in 2017, and we said 2016 we're looking for international platforms, and we found them. We found them with Cytec for sports nutrition, we found them with Remedica for pharmaceuticals into emerging markets and into Europe. 2017 will be clearly under the banner of integration, of synergies. Of course, maybe some smaller bolt-on acquisitions somewhere, but the first focus is really integration at the moment. And if I go actually through these points, these businesses are, like I said, are our roots, are our platforms for the future. And here again, the ficus tree with the strong roots, Cytec and Remedica are our roots for a strong global company. But of course, we shouldn't forget, and Cliff has been doing a great job this year with that, we're focusing on efficiencies and synergies for operative business in South Africa to improve the margins. Continue new product development. The marketing departments around Juliet are working very hard to constantly look at new products, product innovation, product renovation in order to get new ideas into the market. We have to focus on organic growth. Like I said earlier, what we weren't happy with, where we will focus on to bring that organic growth up again, and then further internationalization with some strategic acquisitions going forward. But to remind you again, Remedica and Cytec will change the picture of our business. Not of our philosophy, not our business model. This is successful, has proven to you for the last 4 reporting periods that we do what we promise, and we even overachieve what we promise. But this business is now a 12 billion market cap company. Highly earnings accretive deals with Cytec and Remedica, which had strong support by funders on the debt side, but especially on the equity side. We were hugely oversubscribed, like I said earlier, and we got new international investors on board. Our business next year will be 50% pharma-med, 40% consumer brands, 10% phytovet, still more or less according to strategy. We didn't have a bigger acquisition in phytovet for some time. We always said 40-40-20 is our target. Has slightly changed now because of a stronger emphasis on pharma-med, which of course has also an average higher margins than the phytovet division. But talking about margins, these 2 businesses also will change our margins. And again, like Kieran said earlier on, not a forecast, but if I just take what they have shown in the first 6 months and annualize this, add this to the audited financial 2016 numbers, we will see an uptake of at least or close to 2% in EBITDA margin. That's exciting. And then last, 3,312 Ascendites working now all daily to improve the return on this business, to improve the market cap, but even more important for them, actually, to work on our healthy home, healthy you, and creating a healthy life. Thank you very much. Happy to receive questions from the audience. There is a microphone.
You showed your cost savings, which were your targeted and your actual for the current year, which were achieved. Do you have similar targets for 2017, and are you able to disclose the quantum of that? And as a second question, with the FDA approval for Cytec in America, what is your current strategy for entering into the American market through Cytec?
Saving. So in terms of cost saving, I think Carsten mentioned we've got a synergy or integration team that's currently looking at how we can do things better with what we've got. Certainly one of the bigger projects is with the acquisition of Acacia, that plant that I mentioned in Arsendo. What other Ascendis products can we manufacture in that plant? So how do we get the utilization of that plant up? So products that we're currently manufacturing with third parties, bring them in-house, realize better margins from that point of view. We continue to look to improve back office synergies, looking at our shared service. Right now, of the 35 trading companies, we've got 13 companies under our finance shared services. We're looking to incorporate more as we go along. So we should see savings come about as a result of that.
For some of the targets, for some of the projects, we have targets, but for example, the huge project of bringing outsourced pharma leader production of Spain into Remedica, we don't have a number attached yet, because that is a huge project we're working on, and we just actually paid away the deal 3 weeks ago. So we're working on that with the team. I expect huge synergies out of that project, because Pharma Leader produces 20% of their production needs in their own factory. Everything else is outsourced all over Europe. And they can move a part of that into Remedica, improving the throughput in the plant, improving yields in the plant, improving margins in the Remedica plant. And this is one of the biggest ones actually, which will definitely contribute. Will it immediately contribute in the first 5 months? There is some work to be done to move production sites, get new raw materials, but we're working on that. Second part of your question, Cytec. Cytec has launched since end of March their business into the US. Historically, the business was started in the US with producing in the US, and then they moved the production to Europe. And so they have started now. It's too early to tell if it's a success or not. They didn't launch all over in the US, but they have very good talks with strong retailer chains to actually get listed on these retailer chains. And one retailer chain, I can say so far, we got a vendor number, which is one step before actually being listed from this company. So we hope to actually have more news when we meet you investors in the next months, but at the moment I can't tell more about this. So yeah, there's
Firstly, my congratulations on the results, which have been very impressive. What I would like to know, clearly we've been given a lot of information this morning, and just for my benefit, Ascendis is known as a company whose philosophy is very heavily centered around acquisitive growth. And a lot of the performance that you have been putting up with in the last years since inception have been based on acquisitive growth. If I interpret your figures correctly, you say that the actual increase in profits on organic growth was about 8%. However, your total earnings were increased by about 44%. So one must assume then that the great portion of those earnings were once again through acquisitive growth and not necessarily through a huge contribution by organic growth. That's the first part of the question. Secondly, once again, if I've interpreted your forecast correctly, is that as a result of the acquisitive growth that has already taken place, in the forthcoming year, you are predicting that both your revenues and your earnings will double from 600 million to 1.2. In the past year, you have been cash negative. Presumably, one would assume on paper that this would increase your liquidity, the doubling of earnings. And would one assume then that Ascendis would be a little bit more friendly in the form of dividends? I think your dividends to shareholders this year is about 16% of earnings. Is this forecast to increase?
Yep. And
finally, is in the crazy world that we live in, up to yesterday, the rating of Ascendis was something like 30-1 PE. Clearly now, after the announcements of increased earnings, that will come down, maybe in the 20s. Is this justified? And it's based on a 25% increase, as you've said, each year. So this is what people are valuing Ascendis as a company that increases by 25% every year. Do you forecast that this
Let me answer the first part, and Kieron goes to the second part. First part, there was maybe a misunderstanding. I showed 2 slides. This is the organic sales growth, which is 8%. The next slide shows the organic EBITDA growth. So out of the organic businesses, we achieve 14% EBITDA growth, profit growth, not 8%. So this is what you as an investor want to see, always profits grow more than sales. But overall, our business has this strategy to grow revenues acquisitively 20% and organic growth 10%. You expect then also the profits to grow a little bit more with acquisitive growth than organic growth. But we achieved 8% on the top line, 14% growth on the profit from the organic business, and then the 40% normalized headlines earnings per share growth. Normalized headlines earnings growth, and per share was 30% growth. Just to jump in, the last part of your question regarding multiples, of course the multiple will go down dramatically, and if you include Cytec and Remedica, it will wind down very, very fast. When we actually did our presentation roadshows for these 2 acquisitions, we said at that time with the share price, which was trailing around 23, 24, we expected with these acquisitions are coming in and there's nothing happening on the share price, our earnings multiple would be around 13, 14. So now of course the share price has taken a little bit of that, but earnings multiples have something to do with growth rates, and if you consistently deliver high growth rates, you can show higher earnings multiples. And of course we are with more than 50% a pharma-med business, and in pharma-med you have also higher earnings multiples than in other businesses. And maybe to the second part of the questions to you, Kieron.
Still remember it. It was around cash, right? Yeah. So as I said in my bit, it's a moment in time. So we saw that our cash went down. I think it was versus last year. So we were sitting long on cash because we'd raised funds for the Pharma Leader acquisition. Saying that, we were heavily focused on working capital. We made commercial decision to increase our working capital. It made sense, particularly in medical devices, where you're buying millions and millions of rands worth of equipment from in pounds and in euros, to ship it over, maybe keep a little bit more stock, boost the margin that way, paying less shipping costs. So we're comfortable with that. I think going forward in terms of our forecast, we've set very, very strict working capital requirements for both Remedica and Cytec, as well as our existing businesses. Every single manager in this business has got 2 KPIs that they measured on. One is EBITDA generation, and the second one is free cash flow generation. So the business is very focused on making sure we generate cash. I think we're at a moment in time where at balance sheet date, the cash didn't look good versus last year. But certainly our forecast for Remedica and Cytec, we're very comfortable that those businesses will be generating a lot of cash. As we said earlier, they pay very low tax there, so the EBITDA kind of falls straight to the ground. We have put gearing in there, so we expect them to be highly cash generative. So comfortable in that regard.
And to add a last thing, our business model is around cash generative businesses. Recently we got quite an interesting business on the table which was in the startup phase, and we all know businesses in the early days, they eat cash, they don't generate cash. So we invest, we buy brands which are already established in the market and they have already a track record and they generate cash, which makes also our acquisitive model much more resilient and less risky. If you are acquisitive and you buy businesses which are in a startup phase or are turnarounds, of course you have more risks. The businesses we buy are cash generative, well-trusted brands, long in the market. Some of our brands, when we bought Effecto 5 years ago, Effecto had, I think 1 year later, their 50th anniversary. 50 years the brand in the market. So of course you can expect that these businesses generate much better cash than if it's a very young business. There was a question on that side, I can't remember. Oh, sorry, Greg.
Morning, Carsten. Morning, Kieron. Well done. Just on the cash quickly, I know some's temporary, some structural in nature in terms of tenders, and the medical device business is quite lumpy, I suppose, from a cash flow perspective. But can you just kind of give us your targets from a cash conversion sort of outlook? Because I know we've had 2 kind of years where it's moved, but now it's sort of settling down the business. And are you looking to transform 100% of your profits to cash, or what is the target that people are based on in their KPIs?
It varies from business division to business division. Obviously, some businesses don't spin out as much cash as others, so it varies between about 94% and 100%, depending on the division.
So group, I can just go somewhere in the middle of that.
Correct. Yeah.
Thank you very much.
More questions?
So, Carsten, if I may just say something. One person I forgot to thank in my opening speech is Louis from PwC. I think we had some very interesting and robust debates around IFRS over the last 2 months. So I'd like to thank you and your team. I know you guys put in a lot of effort. And I'd also like to thank you for your pragmatic approach to the preparation of these financials. So thank you, Louis.
And I have a question which I want to ask myself because I got asked that question by somebody who has been visiting this place since 2013 when we had our first meeting here, or 2014 it was. The gentleman asked me, 150 million transaction costs sounds high, but we must put this in perspective of deals of 7.3 billion rand. So that's actually 2% of deals. And we were very adamant that the due diligences we do with very respected companies in Europe doing these due diligences for these businesses. And unfortunately, the lawyers, if you think lawyers are expensive in South Africa, they're even more expensive in London and in Europe. So that actually added up to the 150. But if you take the 150 of the 7.3 billion rand deal costs, it's a very reasonable number of 2%. Deals normally are 3.5%, so 2% is actually quite okay. So just as a question to myself, which I had to answer. Any more? Then I thank you very much, and thanks for coming in this big attendance and this to this transformational results presentation. And I hope to see you all here when, hopefully not on such a cold day in March, which is a contradiction itself. In March it should be cold, but today it's summer, or it should be winter, and it's actually lousy cold in March. It should be summer, but I remember in March it was very cold here when we were here. So next time in March, a hot day here with good numbers on Cytec and Remedica, and to show you the first 5 months of results of these businesses and making Ascendis a global company. Thanks very much.